Something just happened in the gold market that changes everything. And if you own gold, or you've been thinking about buying gold, what I'm about to show you is going to make complete sense of the chaos you're seeing in the financial markets right now. Because while everyone's been distracted by the headlines, by the political theater, by whatever crisis the media wants you focused on this week, something fundamental has broken in the dollar system. And the smart money, the people who move billions of dollars around the world, they've already made their move. Let me show you exactly what's happening. Gold just crossed $4,300 an ounce. Now, if you're not paying attention to these markets every single day, that number might not mean much to you. But here's what you need to understand. Gold has gained over 65% in the past year alone. 65%. That's not normal market movement. That's not just investors being cautious. That's panic buying disguised as institutional allocation. And here's the thing that should really get your attention. This move is accelerating, not slowing down. Accelerating. Goldman Sachs just came out with a projection that has gold hitting $4,900 an ounce within the next 18 months. Now, Goldman doesn't make predictions like that lightly. They're not some YouTube channel trying to get clicks. They're advising the largest pools of capital in the world. And when they tell their clients that gold is going to $4,900, what they're really saying is, the dollar system has a serious problem. But let's back up for a second because I want to show you how we got here. Because this didn't happen overnight. This has been building for years, and most people completely missed it. Think back to the financial crisis. Not the recent stuff, but the big one. The one that almost took down the entire global banking system. What did central banks do? They printed money. Trillions of dollars. They called it quantitative easing. They called it stimulus. They called it whatever made it sound responsible. But at the end of the day, they created money out of thin air to paper over the problems in the system. And here's what they told us. Don't worry, this is temporary. We'll unwind these balance sheets. We'll get back to normal. This is just emergency medicine to get through a crisis. Except they never unwound it. They couldn't. Because the moment they tried to reduce their balance sheets, the moment they tried to raise interest rates back to anything resembling normal, the entire system started to crack. Markets would panic. Credit would freeze up. And they'd have to reverse course and print even more money. So what you've had for the past 15 years is this cycle. Print money. Try to normalize. System cracks. Print more money. Over and over again. And each cycle, the amount of money they have to print gets bigger. The problems get worse. The distortions in the market get more extreme. And the whole time, there's been this one asset sitting there, quietly absorbing all of this monetary chaos. Gold. Now, here's where it gets really interesting because for years, gold was actually pretty quiet. It would move up, it would move down, but it wasn't doing anything dramatic. And a lot of people looked at that and said, see, gold is dead. It's a barbarous relic. It doesn't matter anymore in the modern financial system. But those people were looking at the wrong thing. They were looking at the price in dollars. What they should have been looking at was what central banks were doing. Because while retail investors were being told that gold didn't matter, central banks around the world were buying gold at a pace we haven't seen in 50 years. Not just buying it, accumulating it, hoarding it, moving it out of New York and London and back to their own vaults. China's been doing it. Russia's been doing it. India, Turkey, Poland, Hungary, Singapore. Even countries that you wouldn't expect, countries that have been loyal dollar allies for decades, they've been quietly moving their reserves out of dollars and into gold. Why? What do they know that the average investor doesn't? They know that the dollar system is built on confidence. And that confidence is breaking. See, the dollar isn't backed by gold anymore. It hasn't been since 1971. It's backed by the full faith and credit of the United States government, which is just a fancy way of saying it's backed by the belief that the U.S. will always be able to pay its debts, that the dollar will always be accepted for trade, that the system will always work. But what happens when that belief starts to crack? You're seeing it right now. Countries are making deals to trade in their own currencies instead of dollars. The BRICS nations are building alternative payment systems. Saudi Arabia, which has priced oil in dollars for 50 years, is now accepting yuan for oil sales to China. These aren't small developments. These are fundamental shifts in how the global financial system operates. And every time one of these deals happens, every time another country decides they don't need dollars for trade, it reduces the demand for dollars, which means all those trillions of dollars that have been printed over the past 15 years, they have fewer places to go. Less demand, same supply. You know what that means for the value of the dollar. But here's the really important part. This isn't some future scenario. This is happening right now. And the gold price is telling you that in real time. Because gold isn't just going up because people think it might go up. Gold is going up because the alternative, holding dollars or dollar-denominated assets, is becoming less attractive by the day. When you see gold up 65% in a year, what you're really seeing is a 65% loss of confidence in the dollar system. And the people who understand this, the central banks, the sovereign wealth funds, the family offices managing billions of dollars, they're not waiting around to see how this plays out. They're moving now. Let me give you a specific example of how this works. There's a concept in the gold market called the gold-to-money supply ratio. Basically, you take the total value of all the gold in the world and divide it by the total money supply. And historically, that ratio stays within a certain range. When money supply grows faster than gold supply, which it always does because you can't print gold, the ratio gets out of whack, and eventually, gold has to reprice higher to bring the ratio back into balance. Right now, that ratio is more distorted than it's been at any point in modern history. The money supply has exploded. Gold supply has grown at maybe 1 to 2% per year, same as it always does, which means gold is dramatically undervalued relative to the amount of money in the system. How undervalued? Well, if you wanted to bring that ratio back to where it was in 1980, gold would need to be somewhere around $15,000 an ounce. If you wanted to bring it back to where it was in 2011, the last time gold hit a major peak, you'd need gold around $8,000 an ounce. Now, I'm not saying gold is going to $15,000 tomorrow, but what I am saying is that at $4,300, even with this massive move we've already seen, gold is still playing catch-up to the monetary expansion that's already happened. And that's before we talk about what's coming next. Because here's the thing, the money printing isn't over. It can't be over. The U.S. government is running trillion-dollar deficits every single year. The debt is growing faster than the economy. Interest payments on that debt are now one of the largest line items in the federal budget. And the only way to service that debt without defaulting is to keep the money printer running. The Federal Reserve can talk about fighting inflation, they can raise interest rates, they can try to sound tough. But at the end of the day, they're trapped. If they raise rates too high, the government can't afford the interest payments. If they keep rates too low, inflation spirals out of control. There's no good option. There's only choosing which crisis you want to deal with. And the market knows this. That's why gold keeps going up, even when the Fed raises rates. Because the market is looking past the short-term policy moves and seeing the long-term reality. More money printing is inevitable. Now, let me talk about something that most people don't understand about the gold market. There's physical gold, and then there's paper gold. Physical gold is the actual metal. Bars, coins, jewelry. Paper gold is contracts, ETFs, futures, derivatives, claims on gold that may or may not be backed by actual metal. And here's the problem. There's way more paper gold than physical gold. The estimates vary, but most analysts think there's somewhere between 100 and 250 ounces of paper gold for every ounce of physical gold, which means if everyone who owns paper gold decided they wanted to take delivery of physical metal, the system would collapse instantly. There's not enough gold to go around. Now, under normal circumstances, that's fine. Most people who own paper gold don't want physical delivery. They just want exposure to the price. But what happens when circumstances aren't normal? What happens when people start to question whether their paper claims are actually backed by real metal? You get a squeeze. And that's exactly what's starting to happen right now. Look at what's happening in the physical market. Premiums on gold coins and bars are spiking. Delivery times are extending. Dealers are running low on inventory. Meanwhile, the paper market is showing plenty of supply. You can buy all the gold futures contracts you want, but try to take delivery of the actual metal? That's a different story. This is the kind of thing that happens right before a major repricing event, because eventually, the paper price and the physical price have to converge. And when they do, when the market realizes that there's not enough physical gold to satisfy all the paper claims, the price is going to gap up violently. We've seen this movie before. It happened in silver in 2011. It happened in palladium a few years ago. It's happened in other commodity markets. And every time, the people who owned physical metal made out like bandits, while the people who owned paper contracts got crushed. The smart money knows this. That's why central banks are buying physical gold, not ETFs. That's why wealthy families are taking delivery of metal and putting it in private vaults. They understand that when the system is under stress, paper promises aren't worth much. Physical metal is what matters. And here's something else that's happening that most people aren't paying attention to. The mining supply is declining. Gold mines don't just appear overnight. It takes years, sometimes decades, to find a deposit, get the permits, build the infrastructure, and start producing gold. And the major discoveries peaked years ago. The easy gold has already been found. What's left is deeper, lower grade, more expensive to extract, which means even as demand is surging, supply is constrained. And that's a recipe for much higher prices. Now, I want to talk about something that's relevant if you're thinking about your retirement, your long-term wealth preservation. Because a lot of people look at gold and they think, okay, I get it. Gold is going up. But how do I actually own it in a way that makes sense for my situation? If you've got $100,000 or more in retirement accounts, there's actually a way to hold physical gold inside those accounts without taking a tax hit. It's called a gold IRA. Basically, you can roll over funds from a 401k or traditional IRA into an account that holds physical gold, and the IRS treats it the same as any other retirement account. No taxes, no penalties, as long as you follow the rules. I put together a free guide that explains exactly how this works, what the rules are, what to watch out for. It's in the description below. Worth checking out if this is relevant to your situation, because a lot of people don't even know this option exists. All right, back to where this market is headed. Let's talk about the technical picture for a second, because this is important. Gold just broke through a major resistance level that had been holding for months. When you see a breakout like that, especially on heavy volume, it usually means the next leg up is starting. And the next major resistance level? It's not until $4,800, which means gold has a clear path to run another $500 from here before it even hits the next technical barrier. But the technicals are just confirming what the fundamentals are already telling us. The dollar is losing its grip as the world's reserve currency. Central banks are diversifying away from dollars and into gold. The money supply is exploding. Physical supply is tight, and the geopolitical situation is getting more unstable by the day. Every one of those factors points to higher gold prices. Not just a little higher, a lot higher. Now, let me address something that I know some people are thinking. What about Bitcoin? Isn't Bitcoin the new gold? Isn't that where people should be putting their money? Look, I'm not here to bash Bitcoin. Bitcoin has its place. It's done incredibly well. But Bitcoin and gold serve different purposes. Bitcoin is a speculative technology play. It's volatile. It's unproven over long time periods. And it requires a functioning electrical grid and internet to work. Gold is a 5,000-year-old store of value that works in any environment, including the worst-case scenarios where the power grid is down and the internet is offline. Central banks aren't buying Bitcoin. They're buying gold. Sovereign wealth funds aren't allocating to Bitcoin. They're allocating to gold. There's a reason for that. When you're managing billions or trillions of dollars, when you're responsible for the financial security of an entire nation, you don't bet on speculative technology. You buy the asset that has preserved wealth through every crisis in human history. That's gold. And here's the thing. You don't have to choose between gold and Bitcoin. You can own both. But if you're thinking about wealth preservation, if you're thinking about protecting your purchasing power over the long term, gold needs to be part of that equation. Let me give you another historical parallel, because I think this is really instructive. In the 1970s, the US was dealing with a lot of the same problems we're dealing with now. Massive government spending, rising deficits, loss of confidence in the dollar. And gold went from $35 an ounce in 1971 to $850 an ounce in 1980. That's a 24x increase in less than a decade. Now, I'm not saying we're going to see a 24x increase from here. The market is different. The starting point is different. The circumstances are different. But the underlying dynamics are remarkably similar. Loss of confidence in the currency, monetary expansion, geopolitical instability, and gold responding by repricing dramatically higher. If gold just matched the percentage gain it made in the 1970s, we'd be looking at prices well into 5 figures. Even a fraction of that move would take gold to levels that most people think are impossible. But here's what most people don't understand. Those impossible prices aren't based on gold becoming more valuable. They're based on the dollar becoming less valuable. Gold isn't going up. The dollar is going down. Gold is just the measuring stick that shows you how much purchasing power the dollar is losing. Think about it this way. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. A dollar today? It buys a tiny fraction of what a dollar bought 100 years ago. That's not because gold got more valuable. It's because the dollar got less valuable. And that process is accelerating. Every $1 trillion the government prints, every deficit they run, every time they choose inflation over default, they're devaluing the currency. And gold is simply reflecting that reality. Now here's where this gets really interesting from a market structure perspective. The COMEX, which is the major exchange where gold futures trade, has been showing some very unusual patterns lately. Open interest is declining even as the price is rising. That's typically a sign that short sellers are getting squeezed out of their positions. They're being forced to cover, which pushes the price higher, which forces more shorts to cover, which pushes the price even higher. This is the kind of setup that can lead to a vertical move in price. Because once the shorts are all out, once everyone who was betting against gold has been forced to exit their positions, there's nothing left to hold the price down. And that's when you get these explosive moves where gold can gain hundreds of dollars in a matter of days or weeks. We saw this happen in 2011. Gold went from 1,500 to 1,900 in just a few months, and that was in a market that was much less stressed than the market we're in today. If we get a similar move now, we're talking about gold potentially hitting $5,000 or higher in a very short time frame. And here's the thing. Most people will miss it. They'll wait for a pullback that never comes. They'll wait for confirmation that the move is real. And by the time they're convinced, gold will be $1,000 higher, and they'll have missed the best part of the move. The time to position yourself is before the crowd figures it out, not after. Let me talk about what this means for different types of investors. If you're young, if you've got decades until retirement, you can afford to be more aggressive. You can allocate a larger percentage of your portfolio to gold and gold-related assets. If you're closer to retirement, if you're more focused on preservation than growth, you still need gold, but maybe in a more conservative allocation. But here's what everyone needs to understand. Having zero gold exposure in this environment is a bet. It's a bet that the dollar system is going to hold together. It's a bet that central banks are going to figure out how to unwind all this monetary expansion without causing a crisis. It's a bet that the geopolitical situation is going to stabilize, and maybe those bets will pay off. But do you really want to risk your financial future on those bets? Or would you rather have some insurance, some protection, some exposure to the one asset that has preserved wealth through every monetary crisis in history? That's what gold is. It's insurance. And just like you wouldn't cancel your homeowner's insurance because your house hasn't burned down yet, you shouldn't avoid gold just because the dollar system hasn't collapsed yet. The cracks are showing. The smart money is moving. The central banks are accumulating. The technicals are breaking out. The fundamentals are screaming. Everything is pointing in the same direction. And here's the final thing I want to leave you with. This isn't about getting rich quick. This isn't about making a fast trade and flipping it for a profit. This is about preserving your wealth, protecting your purchasing power, and making sure that when the dust settles on this monetary experiment we're living through, you still have something of real value. Gold has survived the fall of empires. It's survived wars, depressions, hyperinflations, currency collapses. It's survived every crisis humanity has thrown at it for 5,000 years. And it's going to survive whatever comes next. The question is, are you going to be holding it when it does? The dollar just broke. The gold market is telling you that in real time. The only question now is whether you're going to listen.